Hello traders, this is Frank Paul speaking with you on Saturday, February 11th, 2012. Well, actually I'm cheating a little bit. I had to record this example earlier in the week, but thought it's important to keep with our usual weekend schedule. I hope you don't mind. Doesn't really make much difference to what we're going to talk about here. Last week we broached the subject of setting entry stops on support resistance, and I thought that was an important enough subject. It's worth a little bit of repetition. Repetition is how things sink into the brain, I find anyway. I can find a neat idea once and sort of go, that's really neat, and then forget about it and find it a second time and think, gee, that was really neat last time, it's still neat this time, and then a third outing, I'll finally get it. So on the chance that you have a brain that works similar to mine, maybe a little bit of repetition here is helpful. So that's what we're going to talk about again today. As was the case last week, the scenario is as follows. Where you have market flow figured out, you will nevertheless find low-level pullbacks along the way which represent interruptions to that market flow or trend reading. Right? And that's a good thing because we can't sell the rallies in the downtrend or buy the dips in the uptrend if we don't have rallies in the downtrend or dips in the uptrend. If it was just a perfect linear line, well, I suppose that would be even easier because then we wouldn't have to worry about well-timed entries, but you get the idea. We need those disruptions to give us the opportunity to buy and sell retracements as appropriate. So the idea once again is that applying the swing point triple screen concept, we use swing point reversals on the lowest or execution time frame as a reference for setting resting buy or sell stops, the assumption being that a break of that level will represent a continuation if the momentum readings higher up remain intact. So if we have swing points still intact on the 4-hour and hourly chart, let's say they're lows, but then we get a high on the 15-minute chart. Once price breaches that high, we still have lows intact on the higher time frames. We should be good to go. I'm simplifying things greatly here, but that's the basic gist of it. And the execution would be an entry stop, let's say 5 pips on the other side of a counter trend swing point. Whether it's the 60-minute or 15-minute chart or 5-minute chart, I think placing the entry stop, whether a buy or sell, 5 pips on the other side of the offending swing point conflict, that should usually do it. So we've repeated that concept. Let's this time take a look at a different chart example, one we've never looked at before, the US Singapore dollar pair.